Hello, Michael Bull here with the Commercial Real Estate Show. We're at the 2015 National Association of Realtors Conference and Expo in San Diego. And we have got David Lynn here and Peter Burley, and they just came off of a session talking about the 10 top issues affecting real estate. And one of those issues you guys have talked about was the millennials, right? And the impact that millennials are having on real estate in general and on retail, right?
Yeah, it's a huge cohort. It's about roughly 80 million strong younger people entering the workforce, getting their first jobs, increasing their buying power over time, and they're buying a lot more over the internet. Peter can say more about that, but they're different than the baby boomers, how they're buying and the choices that they're making. We're seeing a lot more urban formats. We're seeing a lot more internet buying, of course, and a lot of millennials don't, shop, in traditional department stores. They might shop online and then go to look at an object, a thing that they're going to buy, and then just to make sure it's what they want, and then go back to the internet and buy it that way. So totally different from what we've seen in the past.
Yeah, that's really impacting retail property owners, and these retailers are in these brick and mortar, isn't it?
Exactly. The demographics with the millennials and even with the baby boomers colliding really with technology to change the entire retail format. So we've gone from a sticks and bricks retail format to a mix retail format where you've got internet accessibility, you've got showroom style storefronts, you've got an entirely enhanced view of what retail real estate can be.
Yeah, it's really changed retail, isn't it? That's why we saw these restaurants, and people want to have this experience to get people in the stores. So, and then you have the tax fairness issue going on, and how is all this going to impact? What's the future going to look like from these millennials? What are they doing to us here?
Well, they're not buying as much as well, right? Because they're living in smaller places. They're more urban dwellers in nature, so they're not going to big suburban houses right away, at least. So their houses are smaller, and they tend to be a little bit less materialistic, if I can generalize. But most don't espouse to acquire many cars and boats and a lot of accoutrements of the former baby boomer middle class. So they're a little bit asset light, and when they do buy, it tends to be over the internet, and they tend to be more about experiences rather than things to buy and hoard and keep in their place.
And that's really helped the apartment market, hasn't it?
It has indeed. I mean, they're not buying homes right now, so they're renting their place right now, at least in the short term. And these people, the kids are urban in nature. They tend to want to be in a walkable neighborhood. They want to be able to walk to the store. They want to go to the Whole Foods around the corner and not hop in the car and drive over to Kroger. So they have changed the lifestyle a little bit in the urban core, which is really affecting just about everybody, including the baby boomers who are trying to do the same thing.
Yeah, and so you guys are authors. You've authored several books. What was the name of your most recent book you did?
The Investor's Guide to Commercial Real Estate, published by the ULI, and it's one of their bestsellers. I'm happy to say.
Now that you mention it, I remember reading it. It's very good. Thank you. So, what does this mean for commercial real estate practitioners? I think one of the things that we tend to see in Atlanta, where I live, is that we're seeing mixed-use development, and we're not seeing the big development out on the outskirts of town anymore. It's all kind of urban infill, right?
Right. Right. Go ahead.
They're following demand. They're following where both millennials and baby boomers want to be, right? So it's not just millennials. Baby boomers are coming back from the suburbs. They might be retired, they might be empty nesters, but they prefer to be by amenity, by just cultural activities, by medical care, by transit. And so Peter mentioned this at length in today's discussion, but there's an ongoing urbanization trend that this is all intertwined with. And so a lot of the suburban developments and suburban fringes in general are just languishing while these richer mixed-use developments in the center, in the urban core, are doing relatively better.
But you're seeing some urbanization of the suburb, which is sort of an interesting trend. But when the suburban developers recognize what's going on in the city center, they want a piece of that too. So they're starting to add those amenities into the suburban neighborhoods.
So what are some tips related to all of this that our listeners and viewers could use for investment or development? What should they do to take advantage of it or to watch out for it?
Well, I think create lively centers with that are attractive, appealing, that have services, not just goods but services. So that means restaurants or personal care. Hard to disintermediate that on the web, right?
I can't get a massage online yet, I don't
or
think.
Buy a hamburger, yeah, exactly. And which mixed use tends to be more popular if it's done very well, and people like to more and more live and shop and work in the same general area in well-designed environments, and especially near transit. So if they don't need a car, if they don't have to buy a car, that's a good thing. So those are some of the elements that I see. And by traditional social infrastructure, kind of by museums, by opera, by libraries. Those are also favorable locational characteristics. So
right. A lot of developers go into a place-making mode, and that's all well and good, but you've got to consider what the elements are that you're putting into that place. And a lot of that has to do with the cultural amenities, the social amenities, and whether or not you're going to need transportation to enjoy them.
Okay. And what's the future office tower look like? I mean, with what's the influence there? How are those going to look differently moving forward?
Or we're seeing a lot more collaborative space, so a lot less in private offices, a lot more in collaboration. I think the amount of office space is probably diminished, quite frankly, because people are working from home, they're working wherever they are. But I think offices won't go away, particularly urban offices. So there's good demand for urban offices, but suburban offices have really suffered. But the nature of urban offices, again, it's about more communal, collaborative space, and more play space, and but actually occupancy has really ticked up over the last 5 years because the death of office is certainly overrated, and I think it'll be a strong sector going forward. In good markets, with good amount of service workers,
in the right building.
Right.
There are buildings out there, there are office buildings that are essentially functionally obsolete. If they cannot be retrofit for the new technology, they're probably not going to be bringing in a lot of tenants.
Right.
So that is sort of a word of caution to office investors.
Right. And there's not been a lot of new construction, though, so it seems like in the suburban markets, I live in Atlanta, and our suburban office market is actually doing pretty well, and it seems like that, but it's got to be in the right neighborhood, right? It's got to be, if you've got incomes of 100, 120,000 a year, some of those neighborhoods are more dense, and they'll do well too, right? Yeah.
Right, like Buckhead is a good example, but if you go out to Alpharetta, maybe not as good, not to disparage Alpharetta, but there's some urban submarkets around the country that are trendier, better than most. They have some of the amenities like Buckhead, restaurants and lifestyle and high quality housing, dense housing.
So if I had a choice for investing in some real estate deals, either maybe I'm a limited partner, maybe I'm crowdfunding, or I'm investing in a REIT, where might the properties I want to invest in do well? Do I need to concentrate on where the jobs are going to be, where the utilities and the water is going to be? What are some things I might want to think about?
Yes.
Yes.
We always follow the jobs, always, and always will follow the jobs.
Yeah.
A lot of the investment, though, has been tending to skip now away from the Sweet Six, those gateway cities, the New Yorks and San Franciscos, and they're looking for higher yields, for instance, in the Nashvilles, the Denvers, the Austins. And a lot of those markets are filled with technologically ready properties.
Yeah.
Closing tip, where to invest?
What I'd say not to do is don't overpay. we're really in a frothy, toppy part of the cycle, and I would not pay cap rates below 5%. I would not be the highest price in any market. Interest rates are going to be going up soon, and there's so much competition out there, more capital coming in from domestic and international sources. So I'd be very careful about the pricing at which you buy. Much more important than even where. But I'm also more confident about good quality secondary and tertiary markets. I really am, because many of them have thriving markets, and some of the characteristics that we're mentioning today, like Austin and Pittsburgh, and many very good secondary markets where you can get a higher yield, a better risk-adjusted return than buying it in the top 6 markets that Peter mentioned at really nosebleed prices.
Well, and you brought up, so I have to ask you, well, I have these 2 brilliant real estate minds here on camera. What about these prices and interest rates being so low? We know they're going to rise. Are we in a bubble in some of these core assets in some of these major 6 markets? And what's going to happen to their values in 2 years or 3 years when I guess we all figure that rates, hopefully they're higher, right? Hopefully the economy's back and they're higher. What's it going to do to the values of those properties?
I'm concerned a little bit about some of the yields that people are going to be watching submerge in some of those markets when interest rates start to climb up. People did, I think, overbuy, and they paid too much for properties that really don't have a sufficient buffer against those rising rates. So that's why I would go to some of those secondaries, in my personal opinion.
And I guess what they're hoping is that the barrier to entry and the lack of new construction is going to cause those NOI to grow. And so what do you think, David, about the prices some of these folks are paying? If interest rates are higher in a couple of years, which I guess we all hope they are, and that the economy is strong enough for the Fed to raise rates, what are we going to see for some of the values of these folks paying these kind of low cap rates in these major markets?
I think it's a very dangerous game. I think when you're buying at 4 and even 3 caps, you could be caught on the wrong side of that. Leverage is a double-edged sword, and if you don't have enough buffer, margin of safety, and some leverage ratios, LTVs have gone up to 75, 80, 85%. So kind of back to the bad old days of 2006 and 7.
Right.
So that could be very, very dangerous when cap rates decompress, which they usually do when rates start to rise. And the Fed has signaled that December is when they'll begin that regime change, and rates will rise. So I think it's very dangerous to buy at those kinds of margins, those kinds of prices. So I'm really an advocate of buying it, where you're, have at least 200 to 300 basis points of margin there. But a lot of folks are not doing that, and a leverage ratio of not more than 50 or 60% if you're buying that aggressively.
Yeah. Well, that makes sense, and I guess I hope for everyone's sake, especially people paying those kind of prices, that the demand for real estate continues to increase. They have NOI growth, and they come out okay. Well, gentlemen, thanks for joining us today. We appreciate it.
Thank you, Michael.
My pleasure, Michael.
Michael Bull with the Commercial Real Estate Show at the 2015 NAR Conference and Expo.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. RealNex, software for productivity. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.